If your fixed mortgage is up for renewal in the next 12 months and your lender offers you a blend and extend, take 90 seconds before you say yes. On a $400,000 mortgage, that penalty-free option can quietly cost you $12,000 extra in interest. Here's exactly where that money goes. Here's the one-sentence version. FCAC says many lenders let you extend your mortgage before the end of your term without a prepayment penalty by blending your old interest rate with the new term's rate. That's the pitch, and it's technically true. But the moment you understand how that blended rate gets built, the free lunch starts to disappear. The first thing to understand is why there's no penalty. When you break a closed mortgage, FCAC says you normally pay the greater of 3 months' interest or an interest rate differential, and that can run into thousands of dollars. With blend and extend, you're not breaking anything. You're amending the same contract. Think of it like refinancing your car loan by editing the existing agreement instead of paying it off. No exit fee because you technically never left. So far, so good. Now here's the part the brochure glosses over. FCAC says the lender determines your new rate by combining your existing rate with the new term's rate. Essentially a weighted average. Think of it like mixing hot and cold water. Your old rate is the hot tap, today's market rate is the cold tap. And the blend lands you somewhere lukewarm. You never get the cold tap on its own. And that lukewarm rate is exactly where the cost hides. Independent mortgage analysts put it bluntly. Blend and extend is not free. You trade a large one-time penalty for a slightly higher rate over your whole new term. The gap is commonly half a point to a full percentage point above the best rate you could get as new money. Think of it like a no-fee airline ticket where the fee is just baked into the fare. You pay it either way, or you just don't get a line item to be angry about. Let's make the spread concrete. On a $400,000 mortgage over 5 years, interest at 4.50% comes to roughly $82,000. At 500%, a modest half-point blend, it's about $91,000. That's around $9,000 more, using standard amortization from calculators like Wower and Nesto. Think of it like a subscription you forgot to cancel. Tiny per month, brutal per year. And if the gap is a full point, it's a different story entirely. Where lenders embed the more typical full percentage point, the math gets ugly. On $400,000, the difference between 5.50% and 4.50% over 5 years approaches $19,000 in extra interest, according to industry calculators. That functions exactly like a prepayment penalty. It's just spread across 60 statements instead of one check. Think of it as a slow drip you barely notice. That's the whole design. Make the pain invisible so you sign. There's a second, quieter cost. Because blend and extend is treated as an amendment rather than a new mortgage, many lenders skip re-qualification. One major bank customer reported simply signing the new contract, no paperwork. That feels great when the stress test is tight. But think of it like auto-renewing your gym membership instead of comparing gyms. It's frictionless, and that's exactly why you never walk down the street to check what else is out there. Now here's the trap most people never see coming. FCAC's own example shows a borrower with 2 years remaining signing a brand new 5-year agreement, 3 extra years locked at the blended rate. If market rates drop to, say, 3.5% 2 years from now, you can't just switch. Breaking the blended mortgage triggers a fresh IRD penalty that FCAC says can cost thousands. Before I get to the most counterintuitive piece, what this does to your total 10-year cost, understand that you've now given up your future flexibility too. Here's the counterintuitive finale. Say rates fall and you're stuck at 5.0% for the final 3 years instead of refinancing to 3.50%. On $400,000, that's about $56,000 in interest versus $39,000. Roughly $17,000 more, per industry calculators. Add the initial spread you overpaid up front and the total avoidable cost lands between $18,000 and $21,000. If this is useful, subscribe. The next breakdown is already coming. That's a hidden penalty far larger than any IRD you avoided. Let's put a face on it. Sarah is 38 with $420,000 left at 5.60% and 2 years to go. Her lender offers a tidy blend and extend at 5.10%. It avoids a $4,000 to $6,000 IRD penalty, which feels like a win. But comparing 5.10% to a broker-quoted 4.50%, plus the flexibility she'd lose, the combined cost could reach $25,000 to $30,000 over 7 years, roughly 5 times the penalty she thought she dodged. So what do you actually do? First, log into your lender's portal and pull your real prepayment penalty quote, the true number, not a guess. Second, model a plain renewal against the blend in a calculator like Wawa's. If the gap tops $5,000 to $10,000, the relief is a hidden penalty. Third, demand the blended rate formula in writing and get one broker quote. Treat the offer as a starting bid, not a final price. A fair blend should sit within a quarter to half a point of the best new money rate. Blend and extend isn't a scam, but it is a price product, and now you know exactly where the price is buried. Next, I'm breaking down how the mortgage stress test actually decides whether you can switch lenders at renewal. The rule that quietly traps people with their current bank. If you want to catch that one, subscribe so you don't miss it.